Welcome back. This is Dr. Annette Moultrie, and we are continuing in Accounting 102. In this video, we will cover Chapter 10, which deals with plant assets, natural resources, and intangibles.
But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Also, click on the notification bell so you'll be notified of upcoming videos.
Welcome back to Part 2 of Plant Assets, Natural Resources, and Intangibles. We will begin with Learning Objective 10.2. Account for depreciation using the straight line, units of production, and double declining balance methods. What is depreciation and how is it computed? Depreciation is the allocation of a plant asset's cost to expense over its useful life. Depreciation matches the expense against the revenue generated from using the asset to measure net income. All assets, except land, they wear out as they are used. In addition, physical factors like age and weather, they can cause depreciation of assets. Some assets, such as computers and software, they may become obsolete before they wear out. An asset is considered obsolete when a newer asset can perform the job more efficiently than the old. So depreciation is not a process of valuation. It is not. Businesses do not record depreciation based on changes in the asset's market value. Depreciation does not mean that the business sets aside cash to replace an asset when it is used up. Depreciation has nothing to do with cash. Some factors in computing depreciation. To compute depreciation for a period, first, we need to consider three primary factors. 1, estimated useful life. 2, the capitalized cost of the asset. And 3, the estimated residual value of the asset at the end of its estimated useful life. The useful life is the length of the service period expected from an asset. It may be expressed in time, such as months or years, or usage, such as units produced, hours used for machinery, or miles driven for a truck or a car. The residual value is the expected value of a depreciable asset at the end of its useful life. When a company decides to dispose of an asset, the company will either sell it or they'll just scrap it. The residual value is the amount the company expects to receive when it disposes of the asset. Residual value can sometimes be zero if a company does not expect to receive anything when they dispose of the asset, or if a company plans on trading in an asset for a new asset. Now, the residual value will be the expected trade-in value. Estimated residual value is not depreciated because the company expects to receive this amount at the end. The depreciable cost is the cost of a plant asset minus its estimated residual value. There are three common depreciation methods. You have your straight line method, the units of production depreciation, and the double declining balance method. One, the straight line, two, the units of production method, and three, double declining balance method. So as we work through each method, we will use information from Smart Touch Learning, okay? One here that you see well, one of the items that we're going to discuss in the slides to follow is that Smart Touch Learning has a truck, and the cost of it is $41,000. They say that the estimated residual value is $1,000, and the cost is $40,000. The estimated useful life of the truck, they say, is 5 years or 100,000 miles. Under the straight line method, residual value is deducted from the depreciable cost, and then it is divided by the estimated useful life of the asset. The straight line method is a depreciation method that allocates an equal amount of depreciation each period. So the depreciation method we're talking about is the straight line depreciation, and it is equal to cost minus residual value divided by useful life. And you saw from the previous example, we have the truck at $41,000 minus the estimated residual value, $1,000 over 5 years. So that equates to $8,000 per year. So in the Smart Touch Learning example, again, the depreciable cost is $40,000. That's a 41 minus 1,000. And you're dividing it by the estimated useful life of 5 years. And again, the annual depreciation for the truck will be $8,000 per year. So you see that there's a debit to depreciation expense for the truck and a credit of $8,000 for the accumulated depreciation. Depreciation expense is reported on the income statement. Accumulated depreciation is a contra asset account that is reported. It's reported on the balance sheet. The book value is a depreciable assets cost minus accumulated depreciation. The book value is reported on the balance sheet. A straight line depreciation schedule for the truck is shown here in Exhibit 10.5. Here you see the final column. On the right shows the asset book value, which is cost less accumulated depreciation. Now notice that the depreciation expense amount is the same every year. And the accumulated depreciation is the sum of all depreciation expense recorded to date for the depreciable asset. Okay? So as an asset is used, accumulated depreciation increases and the book value decreases. End of its useful life, the asset is said to be fully depreciated. An asset's final book value is its residual value. The next method is the units of production method. The units of production method allocates a varying amount of depreciation each year based on an asset's usage. The units of production depreciates by units rather than by years. A unit of output can be miles, it could be units, it could be hours or output. It depends on which unit type best defines the asset's use. When a plant asset's usage varies every year, the units of production method does a better job of matching expenses with revenues. Continuing with the truck example. And it to be driven 20,000 miles the first year, 30,000 the second, 25,000 the third, and 15,000 the fourth, 10,000 the fifth, for a total useful life of 100,000 miles. First step is to compute the depreciation per unit of use. So in this case, the asset is expected to have a useful life of 100,000 miles. The depreciable cost of the truck is $40,000. So the truck will be depreciated 40 cents per mile for every mile driven. In step 2, we compute the amount of depreciation for the current period based on the depreciation per unit of use and the actual use. So in this case, 40 cents per mile for 20,000 miles results in a depreciation in year 1 of $8,000. Now, that is the same depreciation amount given by the straight line method. Now, this is only a coincidence because the units of production method is so unpredictable. We have no idea. We have no idea how much depreciation will be in year 2. It might be as much as $32,000 if the truck is driven as much as 80,000 miles in year 2. Or it could be 0 if the truck is not used at all in year 2. So this is just a coincidence. Here you see in Exhibit 10.6, the unit of production depreciation for the truck. Here, the depreciation for the year, you have it at 40 cents per mile. Okay, so you still have the book value ending at $1,000. The double declining balance method, our next method. Accelerated depreciation is a method that expenses more of an asset's cost near the start of its useful life and less at the end of its useful life. The main accelerated method of depreciation is what we call the double declining balance method. Now, this accelerated depreciation method, it computes annual depreciation by multiplying the depreciable assets decreasing book value by a constant percentage that is 2 times the straight line depreciation rate. Note that the residual value is not included in this formula. The residual value is ignored until the depreciation expense takes the book value below the residual value. Now, when this occurs, the final depreciation is calculated as the amount needed to bring the asset to its residual value. Here you see in Exhibit 10.7, it shows the double declining balance depreciation schedule. It reflects the calculation for year 1 and year 2, which was shown on the previous slide. Notice that after year 4, December 31st, 2028, the truck's book value is $5,314. By definition, the truck is to last 5 years, which ends on December 31st, 2029. At the end of the asset's life, its book value should equal the residual value. Therefore, in the final year, depreciation is book value $5,314 less $1,000 for residual value, or $4,314 in depreciation expense. So let's compare the 3 depreciation methods. Annual depreciation expenses amounts may vary, but total accumulated depreciation is $40,000 for all 3 methods. It's $40,000, the accumulated depreciation. Now, deciding which method is best depends on the asset. A business should match an asset's expense against the revenue that the asset produces. Here on this slide, Exhibit 10.8, it shows the 3 methods and 1 graph for additional comparison. Notice that the straight line method produces a straight line on the graph. Why? Because there is an equal amount of depreciation expense each year. The double declining balance method, which is in green, it produces a line that is decreasing. And the units of production, which is red, it varies depending on the usage. The Internal Revenue Services requires that company use a specific depreciation method for tax purposes. Now, this method is the Modified Accelerated Cost Recovery System, or MACRS. Under the MACRS, assets are divided into specific classes such as 3-year, 5-year, 7-year, and 39-year property. Businesses, they do not get to choose the useful life of the asset. Instead, the Internal Revenue Services specifies the useful life based on the specific classes. For example, office furniture has a 7-year life for tax purposes, but might only be depreciated for 5 years for book purposes. The Modified Accelerated Cost Recovery System, or MACRS, is not acceptable for financial reporting under GAAP. Partial year depreciation also applies to disposal of assets, which we will cover later in this chapter. If an asset is disposed of during the year, the business must calculate depreciation for only the time period the asset was in service before the asset was disposed, not the entire year. The modified half-month convention is used for assets purchased during the month. You would record depreciation for the entire month if the asset was purchased on or before the 15th. And you do not record depreciation in the purchase month if the asset was purchased after the 15th. So assume a truck costing $41,000 was placed into service on July 1st, 2025. It has a residual value and a 5-year life. Now, returning to example, we see that the truck was in service for 6 months in 2025, from July 1st through December 31st. So because the business used the asset for 6 months of the year, you would only record 6 out of 12 months, 6 out of 12 months, 6/12 of the straight line depreciation expense, or $4,000 in 2025. Changing estimates of a depreciable asset. For example, the business may find that its truck lasts 8 years instead of 5. Now, this is a change in an estimated useful life. Accounting changes like this are common because useful life and residual value are estimates, and as a result, are not based on perfect foresight. When a company makes an accounting change, generally GAAP requires the business to recalculate the depreciation for the asset in the year of the change and in future periods. They do not require that businesses restate prior year's financial statements for this change in estimate. Here in this example, Smart Touch Learning used the truck purchase on January 1st, 2025 for 2 full years. The truck cost $41,000. It had a residual value of $1,000 and a 5-year life. The straight line depreciation for 2 years is $41,000 minus $1,000 divided by 5 years equal $8,000 per year times 2 years, which will be $16,000. So the remaining depreciable book value, that is the cost less accumulated depreciation, is $25,000. And that is the $41,000 minus $16,000. Now, Smart Touch Learning believes the truck will remain useful for 6 more years. That's a total of 8 years. The residual value is unchanged. So at the start of 2027, the company will recompute depreciation. That is the $25,000 minus the $1,000 divided by 6 years, which will equal to $4,000 per year. Okay. So you want to make sure to use the useful life remaining as the denominator in this formula. In years 2027 to 2032, the yearly depreciation entry based on the new useful life would debit depreciation expense for the truck and credit accumulated depreciation for the truck for $4,000. Plant assets are reported at book value on the balance sheet. Companies may choose to report plant assets as a single amount with a note to the financial statements that provides detailed information. Or companies may provide detailed information on the face of the statement. The cost of the asset and the related accumulated depreciation should be disclosed. Here you see in Exhibit 10.9, it shows 2 alternative reporting treatment for plant assets. The statement is as follows. Treatment 1, you have property, plant, and equipment asset on the balance sheet of Smart Touch Learning as of December 31st. You have land at $20,000, building at $60,000, less accumulated depreciation of $250. That gives you $59,750. Furniture, $18,000. Less accumulative depreciation, $300, which give you $17,700. And the property, plant, and equipment net is $97,450. And here, treatment 2, property, plant, and equipment on the balance sheet of Smart Touch as of December 31st. You have property, plant, and equipment net $97,450. And as you see here, they have a disclosure in the statement. This is the end of part 2, account for depreciation using the straight line, units of production, and double declining balance methods. Thank you, and stay tuned for part 3.
Thank you for watching. And please, if you haven't already,